Okay, and on a 15-minute time frame, the opening price on Sunday, you annotate that, and then you have the closing price on Friday. So that range is your new week opening gap. This is like a real strong price magnet. The market's going to want to gravitate back to it if we're not trending, okay? If the market's going to be consolidating or not in a trending environment, the opening gap on Sunday, if you extend it through all the way through Friday, you're going to see many times price will gravitate back to it. Sometimes it'll go into halfway. Sometimes it'll go completely through it. It'll act as real support and resistance. The way you expect classic support and resistance to work, like you see in the books. These two price levels and the middle of it. What is the middle? That range is extremely sensitive, especially with the low, the high, and the midpoint. So the midpoint level would be 41.40 1/4. This is how you frame high probability. High probability for a short means some measure of buy side has been taken. We see that here. Then you wait for what? Displacement. That means in plain terms, you want to see the market drop sharply lower and take out a specific low. Here's a short-term low. It trades through it here. Once we have that, then we can go back through all this price leg here and look for inefficiencies. That means a specific fair value gap. Now, once you have that price leg identified, you want to go through all your time frames. 5, 4, 3, 2, 1. So we have this price leg from high to low. So anything at this level or higher, we want to look at that as a potential what? Fair value gap. Now, inside this run from the midpoint of this leg higher and lower, that's the price leg that we're looking at. Why this price leg? Because it took out this short-term low on that candle. It's a shift in market structure, bearish, lower prices are expected. We do not look at any rally up as a sustainable run. Why? Because stops have already been taken above this high here. Then there's a shift in market structure below that low. That means that any rally after establishing the midpoint here, once it goes above that, in my mind, I'm thinking we're only going up to go down. So algorithmically, the market will print and produce a premium market. A premium market is where you want to sell your long positions and as partials or enter your short positions. When the market's rallying, that's where you want to short. You don't want to sell in down candles. That's chasing price. That's the reason why I teach the PD array matrix, so that way we can frame a price leg as we're doing here, the high to that low. Why am I specifically aiming for this price leg? Why am I only looking at this one? And why am I looking at this one? Because this one here didn't do any kind of a short-term price run where it created a swing low like this one does here. It rallies up and then it overlaps that entire run and breaks it there on that candle. Once that occurs, as soon as that happens, I'm waiting for price to make a turn and start going back up. Well, what happens here? ICT didn't go above equilibrium, price went here? No, because this level isn't the equilibrium until this low. So if we were looking at this here, did that trade meaningfully above the 50% level? No. And even if it poked its head above that, did it trade to a fair value gap that would be inside that price leg from here to here? No. So look closer. You have this price run down. We're waiting for price to go back above equilibrium, which is the 50% level on your fib. But this run above equilibrium within this price leg here, that sets the stage. Okay, now we are in a premium market, meaning this range is premium. In other words, overbought. From this point here to here, this is discount. This discount, above it or at that level, they're your ideal shorts. As soon as you cross the midpoint of the discount level here, once you get through that there, the highest form of profitable shorts, the highest probability short entries, they have now been exhausted. The only thing you want to be focusing on now is taking partials and trailing your stop. Yes, that's a diamond. When do I stop taking partials or pyramiding? Something like this. See, once we leave the midpoint of that discount range of this price run here to here, and we're in the lower portion of it, we're entering that expansion phase. That expansion phase is likely to not offer very many, if at all, new high probability pyramid entries to add to a position. So there's a threshold at which I will no longer add to new existing positions. But while I'm on that premium area within that price leg, within the market structure that I'm looking for, as I just outlined here, it gives you the highest degree of probability for delivery from your entry to your targets. And you don't want to chase the move and build in more position once it breaks through the threshold I just outlined here. Because to do so, number one, you're going to be worrying about trying to put on another position versus taking off some as it moves in your favor. So from this point on up, we can look for what? A fair value gap. What if you sold short there? Would it be profitable? Yes. Where would your stop need to be? Here, it needs to be at the high. That's a lot. That's a lot of range. But I don't want to have a stop loss like that. Okay, but you're going to have to be more selective with your entries then. Now look closer. Inside this price leg here, what is this? Volume imbalance. Whenever I'm looking at price, I'm looking for those types of things because that's a signature. That's a little glitch in the matrix. Think of it like that. So if you take that and draw it through as it's retracing back up, what's it reaching for? It is reaching for an imbalance in here. Yes, there's one here with this candle. There's one here between this candle's low and this candle's high. Then we have one here to here, specifically with that candle. Which one is better? Yes, you can enter here and have a stop loss up here, but look closer. In this delivery higher, when it ran higher, what is this last up close candle anyway? It's a bearish order block. Why is it a bearish order block? Because it has a fair value gap. Opening price on this candle is what? 4130.00. What's the high on this candle here? 4130.00. You cannot improve on perfection. That's algorithmic. So if you had a series of fair value gaps, which one do you look to trade to or use your entry at? Look for the bearish order block. Look for a volume imbalance or a fair value gap on the other side of the drop. You extend it through. So with that volume imbalance and the fact that it's above equilibrium on that price leg. So the first one you can come to, you could go short there and your risk would be to that high. Trading at this one with the volume imbalance and the fair value gap, and now watch, what's the half of this up close candle? So if you were taking this fair value gap, joining it with the volume imbalance, and it's a bearish order block, price should not do what? It should not trade above the midpoint of that up close candle. Now, if there's no volume imbalance or if there's no fair value gap here on the other side of the displacement leg, then I'll use the first fair value gap above the equilibrium, and then there it is. Now, another version of this would be using this, and I usually do this if I'm going to be building a large position. Like if I know I'm going to be building a large pyramided position up, I'll use this run up where it takes, right before it drops down, it takes a shift in market structure. So this is the displacement leg. This leg here, you split that in half. You would use any fair value gap, fair value gap at this level. This leg here to here, if we had no volume imbalance, if that wasn't there, I would take this low to that high, the equilibrium there, drag that through. This would be the fair value gap at that moment. My entry would be here and framed on this fair value gap there. Show me how to pick the right fair value gap. I just did. Inside this area, if we hadn't already moved so far away here, I would use as an entry. Why wouldn't you take that as an entry? If you knew and you said it was a volume imbalance cycle, you said there was a sell side liquidity, you said it was going to likely go down there, why didn't you take this as a trade? Why wouldn't I take that as a trade? Because of what I've outlined up here in reference to the premium and discount range. Once we leave, if we're bearish, once we break through the midpoint of discount, I cannot take another new entry. I'm managing now. I'm managing my core position. That's it. This becomes a point of interest where I'm going to see the trade be managed with it. My stock could be above this high. It could be at the middle of this up close candle mean threshold because it shouldn't go there. Why? Because I'm expecting this volume imbalance to keep price from wanting to rally all that. Why? Why would I expect that? You see this opening here? We rally up, we drop down. All of this range between from the low and the high, that range has already been delivered to this low. The next candle here, we open, we drop down, and we roll right back over top of 41.18. So we had 2 times between this candle's high and this candle's low. So inside that range, this is now balanced because we've had delivery to the downside. We came off of it. We went down through it again, and then we left what? A volume imbalance. So it's highly, highly unlikely that the market's going to do what? Think. What do you see in here? It's consequent encroachment. A wick is a gap. To an algorithm, they view a wick as a gap. Midpoint of that is consequent encroachment. What price is that? 41.19 and a quarter. So my stop would have to be above that. Be mindful of the low here. So the divergence between the NASDAQ failing to make that lower low. So this is like a turtle soup. How do you trade turtle soup? It takes the low out. It's at a level I already predefined. And then we wait for something to indicate that it's going to go higher. So what is that? We have a failure in NASDAQ making a lower low. It didn't do so when the S&P did go lower. Then we rally. Do I need a shift in market structure on that? No. Turtle soups don't require that. You're trading external range liquidity when you're trading turtle soup. What is that? The low here has sell side. It takes that sell side here. Then it breaks away. All I need is one PD array. It could be a fair value gap. It could be the last down close candle if there's a fair value gap afterwards forming. Or in this case, as I outlined, see that volume imbalance? There it is. It trades down into it and then rallies. If you're bullish, you got to find a PD array that's a discount. And you have to have it show you a defined level where below midpoint of a fair value gap or a order block after a sell side liquidity pool has been rallied, you went below it, then you can trust where your stock can be placed. And usually around 1050 to 1010 in that area, there's a lunch macro. And you want to study when the market's consolidating, okay, you're going to get that price run between 1050 and 1110. What that does is it's kind of like the last ditch before, yes, traders do take lunch, okay? They absolutely do take lunch. The algorithm doesn't take lunch, but it likes to stimulate the volume and sentiment going into that lunch hour, because lunch hour can be a pause else in continuation of a trending day, or it could be a reversal, or it could just stay sideways and do nothing and chop. Here's the wonderful thing about this 1050 to 1110. It doesn't matter which one of those conditions are there. You're going to see a move form between 1050 and 1110. And what is likely to occur is where hasn't that liquidity been tapped into yet? We've already seen sell side taken. Where's buy side? Here, and where I've outlined it here. And if it goes to that level, it's going to expand up into that area here. Now, we took a market shift bullish here. I told you to watch this one here. Even if it just trades in there, that's where you enter. It's called close proximity entries. You don't need a breaker, okay? You don't need a breaker to trade above and come back down and touch it. You can do that. That's how I taught it. But I don't require just that. If I know where I'm likely to see price go to, buy side and buy side, between 1050 and 1110, you're going to see a price run that's originating then. It will happen regardless if there's a consolidation day, a reversal day, or is a trend continuation after lunch. It doesn't matter. You're going to see a price run begin at that. It's a small little segment of price action and time, and it's going to run for liquidity. It's going to run for the liquidity that has not been tapped yet. The levels inside the consolidation between 951 and 1028. While they're in there, everything is going to be conflicting. But once you get to 1050 to 1110, that lunch macro, it's based on this logic. You have to look for where hasn't it been tapped into yet? What hasn't been affected? Who hasn't been upset? Where's the pain threshold for the people that feel the safest? Well, anyone with a stop above this high felt safest, especially when it dropped from here. And when it went down lower than that low there, and then it created a short-term high, traded back down in, and then rally after that fair value gap. Once it ripped higher above here, that is a shift in market structure during a specific time of day, 1050 to 1110. That's algorithmic. Now, this many times can be a key point for the day, and it never returns back down below it or above it in reference to if it was going lower. It's returned back down into that fair value gap right here. That price run to here, this is your last bus stop before you get to your destination. If you don't get on that bus, you ain't getting on it. Now watch what happens. I'm going to look in this small little segment of price action right here. So I'm going to drop down into a 15-second chart. I'm not going to say it, but what do you see? 2 down closed candles, high, low, fair value gap, order block, inside the volume imbalance. It trades down to it, and then boom.